Thanks for being with us this morning. You know, a huge question around all the energy stocks is they're up huge. The XOP has tripled from the low of March of last year, yet it's at about half the level it traded at, you know, over 3 years ago or so. So how much of the trade is already complete in your mind, given the fundamentals of the commodities and demand?
Great. Thanks for having me. I mean, I think at the end of the day, you know, oil has been somewhat of a laggard relative to other industrial metals and a lot of the other elements of the cyclical demand recovery we're seeing associated with the reopening. And so, you know, I think that what the market is telling you is that we still have this latent demand impact that will come. And, you know, higher prices, you know, can drive, you know, the multiples on this sector, you know, higher. So, you know, the simple answer is, yes, there is more to go. But, you know, the direction of oil still really determines a lot of these stocks. But there has been some real structural change in this industry, which is also helping, I think, confidence in the outlook.
Structural change for the better in what sense? I mean, is it just capital discipline? Is that the market doesn't want to tolerate a lot more, you know, open-ended drilling activity? And where does that take you in the way of the stocks you prefer?
Yeah, I mean, absolutely. I mean, I think that, you know, there's a couple of elements here. One is we saw a huge amount of consolidation, obviously, off the bottom. So we saw a lot of very high quality companies transact, kind of strong companies get stronger as good cyclicals do through the bottom of the cycle. We have seen some pretty substantive changes in incentive compensation. A lot of these companies were paid to grow, as you just mentioned. And so I think that's instilled a little bit more confidence in kind of what we call the guardrails around capital and how the companies will return capital to shareholders. So, yeah, there's no doubt that names that we really like in the sector, you know, Devon Energy, ConocoPhillips, Diamondback Energy, all have, you know, very clear value propositions of what higher oil price means for investors. And again, you know, unlike the past cycle, you know, growing production is not part of that value proposition at the current time.
Do you think big picture you will have to accept lower peak valuations in terms of whatever PE or free cash flow multiples just because the market assumes that this is, you know, each cycle is going to be kind of weaker and it's in long-term decline or not?
I mean, I think that, I guess one of the things that we've really been clear about through this, you know, off the bottom of the sector is that we don't have much time for a conversation of what some of the longer secular demand issues for oil are in the context of, you know, still very, very lax demand, right? So let's get back to, call it 100 million barrels of when, you know, we're back in the office, we're flying, we're moving around again, and let's see the market rebalance. And then we can have a conversation about what some of these longer term demand drivers are. But at the end of the day, I think the way we like to think about it is, you know, how much free cash can I generate in the next 5 years? I don't think anybody questioned that the commodity will be with us for at least that time. And in a lot of these instances, if you take a reasonable oil price, you're really getting, you know, kind of 60% plus of the enterprise value back in the next 5 years in terms of free cash. And that obviously lessens the pressure on the terminal value, as you just mentioned, which, you know, I think is here to stay, to be honest.
Shepard Smith here. Thanks for watching CNBC on YouTube.